Hi, this video will discuss taxes. In particular, we'll look at what happens when you tax consumers, how the quantity is impacted, how the price is impacted for the consumer, how the price is impacted for the producer. And one takeaway from this video is it doesn't matter if you tax the buyer or the seller, you will get the same impact on prices and quantities. This is one of 3 tax videos. I encourage you to watch the other 2 videos. One is on the tax being imposed on the seller, and the other video is a tax that discusses who pays the burden of the tax or tax incidence. So let's use Philadelphia and their soda tax as an example to illustrate what happens when you place a tax on, in this case, the tax was placed on the sellers. However, for the illustration purposes of this example, let's assume that this tax was imposed on the buyers. So what would happen in Philadelphia if you went and purchased a soda is you would pay both the retailer, maybe you're buying the soda at Target, you would pay both Target and the government. It's like you would make 2 payments at the point of sale. So this tax imposed a 1.5 cent tax per ounce on soft drinks. So this 1.5 cents roughly translated for a 6-pack of 12-ounce soft drinks, about $1.05. So let's again assume this tax is placed on the buyer. The buyer is responsible for writing a check to the government. Which curve is impacted, demand or supply, if you tax buyers? Well, clearly this would impact the demand curve. How will the demand curve move if you tax buyers? Well, this would move the demand curve down because, or closer to the origin, because the consumer now has to pay both Target, the retailer, and the government. So what will happen to the price the buyer has to pay if you impose a tax on buyers? Well, the price isn't going to get any lower if you tax it. It's only going to increase. So the price is going to go up. What happens to the amount the sellers get to keep? Well, actually, this amount drops because once the buyer pays both the government and the retailer, the buyer's price went up, but they're going to take away some of this amount out of the seller's pocket. And I'll show you this with a graph. What happens to the government revenue? Well, it goes up if you tax sodas. What happens to the quantity sold? We will sell fewer sodas in Philadelphia if we tax them. So let's go to the graph. This is the demand supply analysis. Here is our initial equilibrium price, E2, before we have a tax. At $3.30, we're selling 82 sodas. Now, you are going to tax the consumers $1.05 every time they purchase a 6-pack. So I mentioned previously that the demand curve will be impacted, and it will shift south by the amount of the tax. It will shift down by $1.05. So this $1.05 reduction is seen by moving the demand curve down. However, this is not the new equilibrium point. The new equilibrium point is the intersection of the original supply curve and the new demand curve. So the new intersection translates into a price that the buyer pays now $2.95 at the retail location in Philadelphia. However, they also must pay $1.05 to the government. So this soda that did cost 6-pack that cost $3.30 before now costs $4. $2.95 is spent with the retailer. $1.05 is forwarded on to the government for the total $4 purchase. So our new equilibrium point is this intersection again of the new demand curve and the original supply curve. So $2.95 represents the price the seller receives after the tax bill has been paid by the buyer. $4 represents the new higher price for the buyer. So what happens to the quantity? Well, we have a quantity reduction of 6-packs sold in Philadelphia. We were selling 82. Now they are purchasing 76. The price the seller received dropped by 35 cents. The price the buyer paid went up by 70 cents. Notice one thing important here. There's a $1.05 tax on the consumer. The consumer doesn't pay all $1.05. They pay 70 cents of that $1.05. The seller pays 35 cents of the $1.05, even though the tax is collected from the consumer. The seller still pays a portion of this tax. And last thing worth noting is this distance between this demand curve and supply curve, the original demand and supply curve, that vertical distance is called a tax wedge. The tax wedge, this vertical distance, is the amount of the tax, or the $1.05, this area here in black. So one way you can get the answer without shifting any curves is use your original demand and supply curve and look for the vertical distance to the left of the equilibrium, which is the amount of the tax. In this case is $1.05. If it were a smaller tax amount, say 55 cents, then it would lie somewhere in between these two. If it were a larger tax, it would be somewhere to the left of this E2 point.